Picture this. You've finally found the perfect home, your dream home that you have always wanted. It's in the right neighborhood. It's in the right school district. The kitchen is the kitchen of your dreams. The backyard is more than you ever could have imagined. You can see entertaining your friends and family there. You can see raising a family if that's in your future there. You can see yourself growing old in this property. It is everything you wanted and then some. And then the phone rings and it's your lender. And the lender says, I'm really sorry, but we've hit a snag in your loan and you no longer qualify. Or it's going to cost you thousands of dollars more to get this loan. Do not let this story be your story. Let the story be you find your dream home, you are prepared and know how to navigate not only the escrow process because you are being guided by a true professional, but you also know exactly what to do and how to do it to navigate a successful closing with your loan. Look, I get it. Buying a home is one of the biggest investments you'll ever make. It's very stressful. There's a lot to consider. There are a lot of moving pieces, and the whole mortgage process could feel like a maze of paperwork and quite daunting, frankly. It's easy to feel like one wrong turn could cost you everything. And I don't want this video to scare you. I really just want this to educate you and help you avoid mistakes that could help save the deal of the purchase of your dream home and also potentially save you thousands of dollars. But here's the good news. Almost all of these mistakes are completely avoidable as long as you know what to watch out for. We're going to break down the most common and costly mistakes home buyers make. When we're done, you'll know exactly how to get to closing day feeling confident. And stick around until the end because I have a tip that will save you lots of money and help you pay your mortgage off faster. Let's dive in. I'm Shamika Fox, your Santa Cruz real estate expert. And guess what? I am not going to ask you to like and subscribe today because of you and all of the support you guys have given to this channel. We've hit our 1,000 subscriber mark, which was the goal for 2025, and it's only July. So thank you, thank you, thank you. And I hope you find value in this video. That's it. All right, never gonna bring it up again until 2026 when I have a new goal. Okay, mistake number one that home buyers make is going shopping for a home before they get a pre-approval. And I get it. The home shopping part is the fun part. You want to look at properties. You want to dream about your future. You want to envision what you're going to do and how you're going to decorate the property. I totally understand because I love homes. I love the aesthetics of homes. I love dreaming about what that home and that property can be. But the thing about shopping before you are pre-approved is that, one, if you are shopping out of your budget, chances are you're going to be quite disappointed once you get your pre-approval. And two, if you are shopping without a pre-approval and you find that home of your dreams and then you have to jump through all the hoops to get that pre-approval completed before you submit your offer so that the seller takes you seriously, there is a chance that somebody else who has already gone through the pre-approval process will swoop in and beat you to the finish line. So the fix is super simple. If you are considering buying a home, the first step in the process, if you are not paying cash, is to get a pre-approval completed. Either call the bank that you bank with if you have a relationship with them, or ask me for a referral. I work with wonderful local lenders who will take phenomenal care of you. The fix is simple. Get pre-approved before you even start scrolling through the listings. This does two things. It gives you a realistic budget and it makes you a much stronger contender as a buyer when you find the home of your dreams. Mistake number two people make is not shopping for a mortgage. There are different mortgage products. There are different closing costs. It depends on the bank and the lender. I always suggest talking to 3 lenders. Start with your bank where you currently have accounts, then get 2 additional recommendations from your realtor. I work with people that are not only professional, but they will take care of you. They will make sure that you understand the process and understand what different mortgage products are available so that you can choose the one that best suits your lifestyle. Mortgage fees, mortgage rates, and terms vary from product to product and bank to bank. So what looks like maybe a tiny difference in the interest rate can end up costing you thousands over the life of the loan. So make sure that you shop early, make sure that you choose a product that fits you and your lifestyle, and make sure that you understand the nuances of that product, not just the interest rate, but what it costs to get that interest rate if there are points involved. And also if there are, like, what's your closing costs, what are the origination fees, etc. The credit bureau is smart about this. If you're shopping for a mortgage, generally speaking, within a 45-day window, the credit bureau will understand that having different banks pulling your credit is just shopping for one mortgage, not multiple mortgages. So it shouldn't affect your credit score too drastically. You will get hit in that you are shopping for credit, but you shouldn't get hit as if you are pulling out multiple loans for the same purchase, if you do it within a 45-day window. Now, if you start shopping and then it takes you a year to get your second application, including a credit report pulled, then it will start over and the credit bureau will be notified for that second inquiry. So make sure that when you're shopping for a mortgage, do it within a 30 to 45-day period. And then once you have these 3 different loan estimates, you can put them side by side and see what the different costs are, what the different rates are, and what the different fees are. And they should be able to be easily explained with the lender who has provided you that information, so that you can have a simple breakdown of, this loan is going to cost me more for the origination fee, but it will save me more for the life of the 30-year loan, versus this will cost me less up front, but it will be more expensive over the life of the loan. So things like that need to be analyzed, and I would recommend that you go over that with the lender who provided you that information. Mistake number 3, neglecting your credit score. Loans are based on 3 important factors: your debt to income ratio, that means how much do you make and how much do you owe, and your credit score. So if you have a low credit score under 660 points, your rates are going to be higher. The products that are offered to you are going to be fewer. You won't have as many choices. So make sure that you check your credit score every once in a while. I personally have my credit locked because I don't want anything hindering my credit score when I'm ready to make a major purchase, like a real estate purchase. I want that extra safety protection to make sure nobody's stolen my identity and taken credit cards out, or to make sure that I'm not just willy-nilly applying for credit along the way, that I have really clean, clear, concise control of my credit. That way I know approximately what it is when I go shopping for a big purchase like a house or a car or something like that. So a tip on this is pull your credit from all 3 bureaus at least 6 months to a year prior to you thinking you'll be ready to start shopping for a home and a mortgage, so that you can see if there is anything that you need to do to repair your credit. Now, there are credit repair programs that you can go through. So if you have a goal of purchasing a home by the end of the year and it's July, pull your credit now from all 3 bureaus, see what your credit score is, and if there's anything that is negatively impacting your score, see what you need to do to remedy it. If you have questions or you want somebody to help guide you through the credit repair process, call me and I can connect you with somebody who can actually do that for you, so that by the time you are ready to apply for a mortgage, your credit score is where you need it to be, so that you have more options, and more options means more savings. Mistake number 4 is overestimating what you can actually afford. Remember, I said that a pre-approval is determined based on 3 key factors: your debt to income ratio, that's how much you make, how much you owe, and your credit score. So if you think you can afford a $2 million property, you're putting $1 million down, and you are being loaned $1 million, and so you start shopping in that $2 million price range, and then you actually submit your mortgage application and find out that actually your debt to income ratio is too skewed, it's too high, then you won't be able to get the property that you want unless you have more money to increase your down payment, which will cost you more out of pocket. But it will also be very discouraging because you've got this idea of what you can afford, and when you actually start shopping within your budget, it might just frustrate you. The other factor in overestimating what you can truly afford is that a lot of things are not taken into consideration with regards to your pre-approval. So remember, I said debt to income ratio and your credit, but they don't know what your lifestyle is. If you like to travel every weekend and you know that you have a $4,000 a month budget for travel, but that's nowhere to be seen in your credit because you pay cash for it, the lender doesn't have that information. So it's really good to understand what your monthly payment is going to be based on the loan amount that you will be borrowing so that you can decide whether or not that fits into your lifestyle. A lot of people have kids in daycare. Daycare is expensive. Daycare is not on credit, so they can't see that you paid for daycare when they pull your credit report. The problem with stretching your budget to the absolute max is that you become cash poor and you're married to your mortgage. We don't want to put you in a situation where buying a home puts a lot of stress on you financially. We want to put you in a situation where you're pushing it, but you're actually comfortable enough so that if there's an emergency or something comes up with regards to now I have to add a new roof to my house or fix something that broke and you were not expecting it, that you still have the ability, you still have the reserves, you still can do what you need to do to maintain your property and also maintain your lifestyle. The one thing that I will say is when my husband and I bought our house, prior to that, we used to go out to eat pretty regularly. It was just easier. We both worked. And it was nice. We would have some wine, we'd have some dinner. It was date night every night. We didn't have a kid at the time. Once we bought a house, though, there was this thing that came over us and we just wanted to be here all the time. So even though dining out had been such a big part of our lifestyle prior to buying a home, once we owned a home, our motivations and our intentions and our lifestyle shifted because we wanted to spend more time in our beautiful home that we just purchased. So do take that into consideration too. Buying a home might cost money, but it'll also save you money because you might alter your lifestyle slightly. Mistake number 5 is draining your savings for the down payment. It's a huge myth that you absolutely have to put 20% down on a house. While a big down payment helps avoid PMI or private mortgage insurance, it is not required that you put 20% down. There are different loan products varying from 0% down with a VA mortgage all the way up to as much as you would like to put down, but there's also FHA loans that you can put as little as 3.5% down. Make sure you do understand if you put down less than 20%, you will most likely have private mortgage insurance, so that will add to your monthly payments until you meet that 20% equity in your home, at which point you apply, you have the property reappraised, and once you hit that 20% equity, then the private mortgage insurance comes off. So if you want to keep some money for something like fixing up the house, sweat equity, improving your property will also help with the equity build in your home, then that is something to consider. Keep your money, put 3.5% down, build equity through sweat equity and the cash reserves that you've saved by improving the property, remodeling the kitchen, doing things that add value to the property. And then you can apply to have the mortgage insurance removed after you hit that 20% mark. Okay, we're mid through this video, and usually I would take this time to say, hit that like and subscribe because we're trying to get to 1,000 subscribers by the end of 2025. But we've hit that goal. So I just want to take this time to say thank you for watching. I really appreciate your engagement, and I'm really excited to be here because I am so passionate about real estate, and I love what I do, and I love sharing this knowledge and information with all of you guys. So thank you, thank you, thank you. All right, moving on. Mistake number 6 is not researching mortgage loan options. Like I said, there's different options, different products that fit different people. There's a VA loan that requires as little as 0% down. There are restrictions to that loan. There's FHA loans that require as little as 3.5% down. Those come with private mortgage insurance. There's the conventional 20% down 30-year mortgage. There is a 15-year mortgage. There's a 5-year mortgage. There's even something called a 2-1 buy down where the seller actually pays points to buy your mortgage down 2% the first year, 1% the second year, and then the third year it recalibrates to the percentage that the mortgage rate was at when you secured the property. So for example, Today, mortgage rates are hovering between 6.5% and high 6% range. So a 2-1 buy down would look like a seller giving a credit to the buyer so that the rate is bought down to, let's say that we're at 6.5%. The first year it would be 4.5%. The second year it would be 5.5%. And then the third year it would recalibrate to the 6.5% that the mortgage rates were at the day that you secured your loan. With all of that said, a lot of people are utilizing this to get their foot in the door. They have to qualify at the higher rate, the rate that the mortgage rates are at on the day that they secure their loan, but it alleviates some monthly expenses for the first 2 years with the expectation and the hope that you will be able to refinance into a lower rate mortgage in that time frame. That said, make sure you are comfortable with that higher rate, because if rates don't come down, then you will be paying that higher rate on the third year until rates come down and you can refinance into a different loan. Mistake number 7. This is a huge one, and I've seen it, and it is so scary, and it is so expensive and so unnecessary. Making financial changes and decisions prior to the closing of your loan and your property. What do I mean? I mean, you just got your offer accepted on a brand new beautiful home with a 4-car garage, and you don't have enough cars to fill the garages, and you definitely don't have enough furniture to fill those rooms. So before you close escrow, you decide that it's a really good idea to go buy a car on credit, or lease a car, or go buy furniture on a credit card, or go take out a new credit card so that you can buy furniture from, I don't know, Pottery Barn or whatever store you want. Your lender will do a final credit check before they fund the loan. That's at the very end of escrow. If you have not only new credit cards out, but new payments, it will skew your debt to income ratio, and they could refuse funding your loan, which means you can no longer close on the property. And chances are your contingencies have already been removed because we're that far along in the escrow process, and now your deposit is liable. So do not, I repeat, make any financial changes or big financial decisions. Don't take out a new loan. Don't take out new credit cards. Don't lease a car. Don't buy a car. Don't use your cash reserves. Don't change jobs. Don't quit jobs. Just stay put until the property closes, until your loan has funded. And then if you want to make that decision and you feel like you can afford that decision, then you can go ahead and do it. But I have seen this where a buyer is getting ready to close and they're so excited about their new house that they want a new car in their driveway. And they go and they lease a new car, and now their debt to income ratio is skewed, and they have a beautiful new car, but they've lost their deposit and they can't close on their house. So please don't fall victim to this. I tell all my buyers, once they start shopping for a home, your credit is frozen, your money is frozen. Do not do anything with regards to job changing. Now, of course, if you lose your job, if you get fired or let go, then that needs to be told to your lender immediately so that we can figure out a way to navigate through this and hopefully protect you from losing your deposit. Hopefully your contingencies are still in place. But otherwise, do not, I repeat, and this is very important, do not make any large financial decisions. Do not take credit cards out, do not buy a car, do not lease a car, and do not change your job until you close escrow on your new home. Okay. Mistake number 8 is not reviewing your mortgage documents for errors. If you were given a quote at the beginning, and the lenders are required to give you an estimate, a loan mortgage estimate, what the fees are going to be, what the rate is going to be, and then once everything is locked in, that should not change. So if you get to the closing table and you have loan docs that you sign off on, and then you realize after you've signed off on your loan docs that the rate is different than the rate that was quoted to you, and that the rate that was supposed to have been locked for you, there is something wrong with your mortgage. There is something wrong with the lender. Hopefully it was only a clerical error and there wasn't some funny business going on, but make sure you review the mortgage documents when you get them and then before you sign them. Mistake number 9 is misunderstanding discount Points and fees. When you get your loan paperwork, you might see an option to pay for discount points. Lenders often sell these as a fantastic way to get a lower interest rate, and while that's true, it's not always a smart move. A discount point is just prepaid interest. 1 point usually costs 1% of your loan and might lower your rate by something like 0.25%. The catch is that paying for points only saves you money if you stay in the house long enough to hit the break-even point. That's the moment when your monthly savings finally add up to what you've paid for those discount points. So if you're considering utilizing discount points to get a loan product that feels more comfortable for you, make sure you understand how long it will take you to recoup those discount points that you paid up front. So if it's going to take you 10 years and you have a 15-year loan, or you know that you're going to refinance in the first 5 years because your financial situation is different, or you absolutely are certain that the rates are going to come down, don't pay points that are going to take you 10 years to recoup. Okay? That's important. That's going to save you money. For example, before you agree to pay for points, you have to do the math. Divide the cost of the points by how much you'll save each month. So if a point costs you $3,000 and it saves you $30 a month, your break-even point is 100 months. That's over 8 years. If you think you might sell or refinance before then, and the average time people are actually in their home is 7 years, that's a good statistic to know, you'll actually be losing money on the deal. So make sure you understand the cost of the points and how long with the discount you will be receiving will it take you to make up those points that you paid up front. And mistake number 10, before we get to the bonus tip to save you lots of money, is overlooking first-time homebuyer programs. Many banks and lending institutions offer first-time homebuyer incentives. I just closed a transaction with local Santa Cruz Credit Union, Bay Federal, and they offer closing costs to be paid for first-time buyers. That is thousands of dollars in savings, and it is only offered for first-time buyers. So make sure when you are shopping for a mortgage, if you are a first-time buyer, your lender knows that, and ask them if they have any first-time buyer loan products that will help you save money in the mortgage process. Now we have gotten to our bonus round. And the bonus round is how to save money by cutting your 30-year mortgage in half. And I love this one because I personally don't like loans. They stress me out. I like to have everything paid off in full. I don't like owing people money, but I get that mortgage loans are actually, they're leverage, right? It allows you to keep your money and reinvest it. It also allows you some additional write-offs with regards to your interest. That said, if you have a 30-year mortgage and you want to pay it off in 15-ish years, what you can do, this formula is really cool, is you can add 2 extra payments a year and break it down divided by 12 and add those into each month. So for example, you have a loan that is $1 million. I'm going to say, let's assume the interest rate is 5% because I have some clients that are at 2%, believe it or not. And then I have some clients that have recently purchased properties and they're in the 6.5–7% range. So let's just say 5% for the sake of this argument. So you have a loan for $1 million. Your rate is at 5%. Your loan term is 30 years. If you take 2 extra payments per year and divide them monthly, it will reduce your mortgage payback time by 15 years. So what does this look like? And I'm going to add a graph and a breakdown for you so that you don't have to guess. But this is what it looks like. For a $1 million loan with a 5% interest rate over 30 years, the standard monthly payment using a mortgage calculator would be approximately $5,368. Add 2 extra payments per year. If you add 2 extra payments per year, the extra amount added each year would be the equivalent to $10,736. Divide the extra payments by 12, so that's $10,736 divided by 12, and we come to $894.67 per month. So your new total monthly payment has now changed from $5,368 to $6,262.67. So as you can see, it does not increase your monthly payment more than $1,000, only $894.67, almost $900 a month, but it decreases the time that you pay back your loan by 15 years. Now, if you are using this method, make sure that you let your lender know that the amount that you are adding in excess to what is due is to be applied to the principal balance. Make sure they know that. That's important. I'm going to repeat myself. Make sure if you are adding any additional money to what is due on a monthly basis, paying back your mortgage, that you let the lender know and you confirm that this money is to be applied to the principal balance. You don't want them to use it towards your interest. The effect on the loan: by increasing your monthly payment to $6,262.67, you are essentially making these 2 extra payments each year in smaller, more manageable portions. This accelerates your loan payoff timeline significantly, reducing the amount of interest you pay over the life of the loan. The outcome is that your 30-year loan has now been cut in half to a 15-year loan. I don't know about you. The cool thing about this though, okay, so why wouldn't you then just get a 15-year loan? You wouldn't get a 15-year loan if you have volatility in your income, if you have volatility in your debts. Because if you get a 15-year loan, you're going to owe that amount, period. There's no negotiation unless you refinance. With the 30-year loan, you have the flexibility. You have 30 years to pay it off, but if you are able to add those 2 extra payments a year divided by 12 so that it's not so burdensome at the end of the year, then you have the flexibility to do it, but it is not a requirement. Okay, that's my bonus tip on how to save money and time with your mortgage. So if any of this has been valuable to you, or you have additional questions on the mortgage and home buying process, please feel free to reach out to me. I love talking about this stuff. I've been selling real estate for over 20 years in Santa Cruz. If you have any questions about the Santa Cruz market, please feel free to send me a message and we can schedule a time to chat. Or if you are looking to buy or sell out of the area, fill out the form in the comments below and I can set you up with a realtor in your area. Thank you so much for tuning in. Thank you for helping me hit my goal of 1,000 subscribers in 2025. I hope you found value in this video, and until next time, I'm Shamika Fox.